All right. Good morning, everybody. It's FOMC week. FOMC suppresses volatility. So the base case argument is always that we're going to hold the line into FOMC. Uh, we've seen examples lately where we don't do that. So that might be the base case argument because it's what we get, you know, statistically on average. The problem with that average is, have we been in a rate hiking regime? Have we been in a pause regime? Have we been cutting? So when you look back throughout history, the Fed is more often in a pause stance rather than in a hiking or cutting stance. So when we consider the statistics that we've been sideways into an FOMC week and that it suppresses volatility, it's taking a lot of assumption with that, right? So sure, on average, Monday and Tuesday and half of Wednesday, we will hold the line, go sideways, because statistically, that's just what we do on a Fed week. But always ask that question: how is this Fed week different than the previous Fed weeks? We've been holding the line now for over a year. Bloomberg actually came out with a really good article. I haven't got to read it yet, but I was listening to him talk about it this morning. They were asking the question, how come everybody thought the Fed was going to cut, and where did these 6 cuts come from? If you remember, they were pricing that in back in December and January. And where did all this discussion of cutting come from? Well, it was the Fed and the Fed's signals that they had given through interviews and the dot plots and everything else. So they used AI to analyze headlines going back over the last 6 months. And they said it looked like the Fed had already eased by at least a half of a basis point. And, it's interesting because the Fed says frequently, a lot of times we don't have to raise or cut. All we got to do is signal policy changes in our language and tone, and the market will price in that liquidity. So if you have access to Bloomberg articles, maybe take a look around. You could probably find it pretty easy. It was in today's. Uh, if not, they are trying to do more podcasts on their different headline news. So you might be able to find it in a podcast. They're making Bloomberg more and more accessible, even without a subscription. So you should be able to find something. We're going to get a lot of data out of Europe today, or at least a lot of Fed speakers out of Europe. It's kind of a quiet Monday, all things considered. Uh, Tomorrow, there's good size companies reporting, including Amazon. But today, there's really not a whole lot on the table, so everybody's going to be watching Europe. Japan's up the most at more than 1.25%. UK right behind that. The Nasdaq at just a quarter, with the S&P. Dow not even able to make a quarter, and small caps just lucky to be green at this point. As we can see on Market Watch, nothing scheduled. There really now this place, Market Watch, really only hits the U.S. markets, and they try to target only the biggest events. Nothing scheduled. Take a look at FX Street. We're going to get some data out of Europe. We got Fed speakers out of Europe. We've got some auctions in the front end in US. And then tonight, after the market closes, take a look at Japan. They've got a lot of data coming in. Now, Japan continues to give the little wink and a nod that they are interested in doing intervention, but at these levels, it would just be so expensive that they're trying to time it. We've seen coordinated central bank intervention before, and if they want the best bang for their buck, they'll partner with somebody else to get the most out of it. So you want to kind of think, when would it be the most advantageous for them? Who can they partner with to get everything that they can get out of that intervention? And if you look at the last one, you know, they got quite a bit of assistance from Powell last time. So would it be during FOMC week? It's always possible. So major earnings, we can see tomorrow, Coke, McDonald's, Starbucks, Amazon, AMD. It's big names. All right, so the halfback here, 51.50. This halfback level is from this peak at 53.34 all the way down to basically 49.75-ish, right around that level. Right? It's that range for this halfback. So we're just going to make that stand out a little bit. When we think about this run up and the pullback that we've now had, this is a critical line in the sand that we have to get through. It's not the only one we have to get through. It's just one of the most important ones. Once we do get through that, we still have to work our way all the way to the top and set at least an equal high, if not a new high. If we do anything less than that, then this sets a lower high, and then it starts putting us into a complex topping pattern. At this point, we don't know if we have a topping pattern, complex topping pattern, or if it's just a pullback in this really good run. We need more out of the candles. So 51.48.5, if you want to be very specific, 51.50 for options levels. It's a critical line in the sand. We got to keep it, got to get it, take it, and then stay above it. And it's right at the 10. Now, I've got two blue lines there. They're both the 10. One is the 10 EMA, the other is the 10 SMA. We're on a weekly. I don't try to distinguish between the two. This is the solution that I came up with after years of people asking, what is that, the EMA or the SMA? How about I just put both on there and I say I don't care, because I don't care. It doesn't matter. Either one. That 10 is there. We got to get above that. And then there's still the cog line at 52.11. So we still have a lot of resistance overhead that we have to deal with. We have last week that we now need to mark a half back on. So we'll just use the previous week's line and we'll move it down 76.25. The cumulative volume still seems to be sloping to the downside. That hasn't changed, but we are in a little bit of a bottleneck at this point. All the moving averages are tangled together. We're underneath all of them. All of that is a bearish implication. It has to change. Hasn't yet, but if we're going to be bullish, then we've got to get like a TRB and break this Bollinger Band and really start expanding to the upside. This is CVI's cumulative volume index. We can see the volume's a little lower this week, sitting at 75. That's the lowest it's been for a while now. April 15th is as far back as I've got this chart set, and we didn't see volume in the overnight this low in all of that time. So we'd have to go back even farther than that. It's still decent volume. Anything above, say, 68, 65, if we really want to give it a little. So we're in a normal volume range. It's just lighter than what we had been seeing. I double checked with the spot gamma, we are above the call wall this morning. Now, we don't have the AM edition of the founder's note yet. We just still had Fridays, but that call wall is on the cog line 5132. So we are above it, which is not unusual. It happens all the time on the NASDAQ, which is a more illiquid product when it comes to options on the futures, which is what all these levels are derived from. The NASDAQ is so illiquid that it's constantly jumping over all of these levels, and it's just a little more uncommon with the ES, but it does happen. We've really tried to get an inside day breakout, haven't been able to take it and keep it. So we're holding in this really tight pattern. We're above the daily pivot point. We haven't hit it yet, which is an MDP. We're holding above the call wall, which tightens that lower end even more. And yet we're flat against the ceiling. So this is a very tight range, lots of compression, and it won't stay here, right? It's one of my favorites. You can't stay here. I don't care where you go, you just GTFO, right? You got to get out. So this is a very simple play at this point. Let it leave the box. You got to trade, whether it breaks to the upside or not. We would assume that on an FOMC week, any break to the upside would just be sold into, but don't just make that flat assumption. There's a lot of reasons and a precedent behind in this last 6 months or so, even say a year, where we can point to more than one FOMC week where we started the week and we made a big move on Monday and part of Tuesday before we finally settled down, stalled, went sideways into the afternoon of Tuesday into Wednesday, waiting for FOMC. But we first had a big move on Monday and part of Tuesday. So breaking outside of yesterday's high could give us a reasonably decent expansion. If it does, then we'll just target the ADR half and the ADR full. It'd just be another day at the office. Otherwise, breaking our low at this point put us through the call wall, get through that for the daily pivot point. Beyond that, we can mess with the 5 of yesterday or Friday. It's the first 5-minute candle. Then the RTH open, Globex low, RTH low, and that puts us down into the ADR low. There's a volatility trigger in all of that, zero gamma line as well, and the previous week's close also. So a lot of levels now underneath us that we've already worked through, and still a lot of levels above us to get through. And we're tightly wound inside of all of it. They're not hedging yet at this point either. 10-day, 30-minute volume profile, we don't quite have a classic signal. We can't really call it a B because this part isn't high enough. And we can't call it a classic D because this part up here exists. But through the day today, we're going to lose this volume. That will greatly narrow down this profile unless we break to the upside here and continue to move up. So that's something to consider as well, whether or not we're going to be able to break this level. We've got all this shallow zone, so there's nothing on the volume side from old volume that we have to worry about. We should be able to transition through that relatively easy. But if we don't, then by tomorrow when we come in, we'll have the classic D shape. And we'll have all of our levels in a very tight range. I think this has already been hit, but we'll bring it up and check. It has not. They missed it. So VPOC 51.34, probably could adjust it, move it up a tick. We haven't run through it, so it's still VPOC. That's just one more level that's in our path to the downside. But on this 5x5, you could really see the narrow range here and that classic D shape. And look at where the bulk of all the volume is at. Of course, it's also where we spent the most time, 51.43. It's in the upper edge. All right, we're just slightly above the 10-week, but we are above it, which puts it underneath us, acting as a sort of psychological support level. Bullish above, bearish below is the concept. So we wouldn't look for short opportunities necessarily until we were back down below that level. Of course, that's a weekly, so bigger picture. We tend to use a weekly as a where did we close concept. And as long as the weekly candle is still open, then we don't use the current candle for any official analysis. An easier way to think about that, say you're going to act on a candle signal like a doji or a hammer, something like that. It's not a doji or a hammer until the candle actually closes, right? Until the candle closes, it's just a candle that's moving around. Once that candle closes, then you can point to it and say it's a doji, it's a hammer, whatever. But until you get it closed, it's not. We're 0.5% above the 10-day, but we are above it, working on the cycle to come back up. The target is still going to be somewhere around 1.3, 1.4. That's been the average turnaround spot all year. If we look back historically, we've been higher than that. We've gone higher than the 10, much higher than that. But the average right now seems to be that we turn around before we get more than 1.5% away from the 10-day. So anything more than 1.25, pushing your luck. So last week, we measured the range and it looked a little short compared to the week that we had, but we have to wait for Friday to close before it's set in stone. So it gave us an early glimpse, but it doesn't count until after Friday. And so now that it's after Friday, we can measure last week's range, set it on this week's range, and talk about the volume, the volatility difference. These three lines are derived by volatility. Well, basically two of them, the red one and the green one. When volatility is greater, the distance between the red and the green line is wider. It's the one standard deviation. Weekly expected move. How far could we move? And then how far should we move is set by those two lines. Another way to think of it is 70% of the time, a market should stay within its weekly expected move. For the S&P, oddly enough, it's 80% of the time, even though it should be 70. It's just so accurate with its expected move that it generally maintains that 80% rate until times of crisis or when volatility really starts to pick up, and then it starts to break that 80%. We're only focused on at the end of the week. On Friday at the close, did it close inside the box or not? And rather than counting every single week over the last year, 2 years, 5 years, it's really easy just to count back over the last 10 weeks and ask on Friday at the close, did we close outside the box? And how many times did we did that over the last 10 weeks? If you find that we did it more than twice, then we're not maintaining that 80% accuracy. And it's usually a heads up not to play iron condor strategies, not to do butterfly strategies, because the market is making bigger moves than it's supposed to. And it's very likely to break any kind of target like a butterfly. And it's more likely to break a range like an iron condor. Last week, we closed outside the box. The week before, we also closed outside the box. And the week before that, we closed outside the box. That's 3 weeks in a row right there. That breaks that 80%. And we could continue to count back. Here's another one where we closed outside the box. So at this point, it's nearly as good as just flipping a quarter. Heads or tails. I can do better than that. So just keep in mind that the market is breaking its expected move. Goes to the heart of volatility and the fact that the market makers aren't pricing that volatility into the market. We're not seeing it come through in the implied volatility averages. Bitcoin is down, communications, and that's pretty much all that's down this morning. Things that are up: consumer discretionary, the VIX, uranium, bonds, the FANGs, biotechnology. Oddly enough, China. So we got a discrepancy between KWeb and MSCI China. KWeb's more of their internet, China tech, I guess is a good way to think of it. So it is a discrepancy on the China names. But more than likely, there was a company that's having earnings or had a big news report that knocked KWeb down while the rest of the China markets are doing pretty good. We can see emerging markets is up. That's basically China. And MSCI China is up. So probably a tech name like Baba, Baidu, one of those. Yeah, Baba's basically flat. Baidu's up. EDD down. JD down. Neo up. So maybe some of those EV names, XPEV, Neo, the mixed bag out of China then. We did see that the FANGs were up. So got Amazon, Apple, not Microsoft, and not Google. And Tesla is up. So Amazon and Tesla looking really good. Netflix is basically flat, holding that 20-week. AMD with a breakout, but not NVIDIA. Really not semiconductors either. We can see the ETF consumer discretionary is up, but that's very likely Tesla doing that. Uranium, but there's not a lot to it. You can see that these are just dashes, not really showing, liquidity. Solar is up. Look at it on the daily, it just breaking outside of Friday's range, but still inside last week's range. Bonds also up. Now that's some flow, more than just a little bit of a dash. We've actually got a continuation move here this morning. But that is a significant downtrend. It has a lot to prove before we would even consider the idea that we're getting bullish in bonds. Let's start with this inside day breakout and work on getting an inside week breakout. But it is a good start to see bonds moving up. That means we should be expecting yields down, maybe the dollar down, US dollar, Japan down. That ought to help out a little bit. And then we don't have precious metals showing up here yet, which means we don't really have that resistance against the NASDAQ either. So emerging markets, it's just a little dash up here, not showing any liquidity yet. Bitcoin being down might offer us some good moves in that space. Riot, Mara, Hut, Hive, Coin. I mean, it's not looking all that good anyways. Take Riot, have this run up into all these weekly moving averages. It's in a tangled trash mess, and it looks really close to a halfback level too. Not quite, but close. So it failed to get this push, faded back, and now it's fading even more. We want to look at last week's midpoint. As long as it's holding above 11.12, then I wouldn't try to short it in a short-term swing. Otherwise, if it breaks 11.12, we could run it back to last week's low and then try to get this gap filled. The thing is, and this is where my caution comes in, this is a weekly chart, and that's a weekly gap up after a really nice reversal. This signal, this pattern is really beautiful, and it's crazy bullish. So I don't want to short into that until I have a really good signal to short it. Breaking 11.12 at least gives me permission to short it, but I mean, to be fair, we'd really want to break 9.58 before we'd consider this a decent short. But if you're aggressive, breaking 11.12 at least gives you that. It's an honest signal for a short. But this weekly gap up, and it kept the gap. That's a very bullish signal. Now, this is just one, right? This is Riot. It's an ugly chart. It's beat down. It's underneath all those moving averages. It's a bullish signal in a sea of bearish signals. Take something like Coin, also has that gap up, It's not as strong. This signal of a reversal isn't as good as the one we were just looking at on Riot, but it is a reversal. It is a gap up on the weekly, and it did get back above the 10, and it's already above the 10, the 20, the 50, the 200 on the weekly. So, you know, if we're looking for bullish signals, at least this is more valid because it's built in with all these other bullish signals. Mara, same jumbled trash. Nice gap up, but the gap got closed. Still underneath a couple of these moving averages, and bigger picture is still underneath a lot of this other trash. So we got some Bitcoin stuff moving around. We would expect them to be down more than they are. I think they're done with that halving. Yeah, we've already broke completely down on GBTC, completely outside of Friday's range. Well, actually, the entire last week's range, which gets us a break below the 10-week moving average. So now 56 is resistance. It's a short below that, as long as we're holding below 56. If I was looking for some targets, not last week, but the week before, I would use that halfback and that low. So a break below 55 is 73, gives us a target to 53.11. That'd be a good start. All right, we got the 10-year trying to break down below the 10-day moving average and the 3-day moving average and the 3-week moving average, which is all good. That's like a surge to the downside in 10-year. The dollar is already underneath the 10 and the 3, and gold sideways riding underneath that 10-day, testing as resistance. There's a theme that talks about gold going up around FOMC, and I've never proven that. You know, I've never run like back tests on it or anything like that, but it seems like it, right? I've been hearing that now for a couple of years. If you like looking for alternative trades during FOMC, you know, since the Magnificent Seven and the S&P, NASDAQ tend to do silly things during that FOMC week, it might be worth taking a look at gold or silver, see if there's a play there. Right? Still watching US dollar Japan. We want to see it get below that 10-day moving average. It broke the 3. Right now it's just stuck between the 2, but it would be good to have that finality to it, that decisiveness, breaking through the 10-day and staying below it, unlike earlier when we broke down below it and we popped right back up again. And that does look like a really good bear trap. But at this point, we're still setting these lower highs. So if it was a bear trap, it seems stalled. We're still running a zipper on the ES and the NASDAQ too. Just reciprocation play. whatever we got from the bottom, we got on the top of VWAP. And same thing. So we're just holding the line at this point. And pot stocks are up this morning. That just came back around. You can see it's only this current candle that gave us the pop. It's a nice follow through from Friday, but we're still inside of last week's range. So let's get outside of that. That's a big ask to get outside of last week's range. And then there's this really big candle to keep track of. All right, so we're looking at a daily chart here. I went back a little ways, full year. So we got a better picture. We can see the 200 period moving average turning up. Price is now above it. All the other MAs are above it. We tested and it held once, but it really needs to keep it. So this pop to the upside is good. There's still a lot of work to be done. This is a sloppy, nasty mess, but we are getting higher highs. And we are getting higher lows, as ugly as this is. And we do have that upsloping 200, and all the other moving averages are above it. So, if you're thinking like Wyckoff theory, accumulation distribution, we had this big distribution and then that basing pattern, and we're now finally starting to roll it over and take it back up. Long-term move in this thing, right? Not sure what caused that little bit of a pop up that we saw in TrendSpider, but we're not seeing it on Thinkorswim yet. That's not unusual, by the way. If you swap to different tools like TradingView, Thinkorswim, TrendSpider, you'll notice some pre-market activity on one that you don't always see on the other. Really just depends on your source. So Apple, Tesla, and Amazon, but Amazon's giving it up a little bit. Three of the fangs were really looking good. Now it maybe just two, Apple and Tesla. Just keep in mind there's still earnings on deck for a lot of those. I know a number of traders who take FOMC week off. And when I first heard about these traders, they call timeout on FOMC week. They take vacations, do honeydews, whatever. They just don't trade. At first I thought quitters, what is it's just another week. Why quit now? But they're not wrong. A lot of the times, the weeks, at least the first part of it, are trash. The tools that we normally use don't quite work the same way, like tick, trend, AD, UVol, DVol, weighted AD, that sort of thing. They're just always a little bit off. Then you get the strange moves in the dollar, the 10-year, some odd actions in the ES and the NASDAQ. So, they're not not necessarily a bad idea. If you're already struggling as a trader and you find day trading on a day-to-day, week-to-week basis difficult, using this week to do some research, develop some statistics on your strategy, review some trading that you've already been doing, something other than trading live if you're already struggling, probably not a bad idea. Yeah, month end is a really good point too. It's not brought up enough, honestly. So that's a good one to bring up. And I didn't mention QRA today, but I had been mentioning it for well over a week. There should be an 8:30 QRA. It's a two-piece data point. Everybody focuses on Wednesday's QRA data, but there's QRA data today too. There's always one on the Monday, and then there's one on the Wednesday. So that's thank you for the reminder. I'd been saying it so often it just got to the point where I quit saying it, but I shouldn't because it's a really big deal. So not a bad idea if you're already struggling to just call timeout and not trade this week. It's your account will probably thank you for it. So 10:30, 11. Well, if you see any auctions at all, then just assume that you're going to get all three auctions, 11, 11:30, and 1 o'clock. They're only showing the 11:30, but I would still look for 11 o'clock price action and 1 o'clock price action. And then at 2 o'clock today, even though it's not on here, it might be 2:30. I'd have to check. We're going to get part of that QRA data. And then on Wednesday at 8:30, we're going to get some of that QRA data. That's what I got for you guys. Be careful, be safe, watch the clock, and I'll see y'all tomorrow.